guys, welcome back to the Capital Mindset Show. Today we're going to be reviewing Amazon's earnings and kind of discussing about a lot of the topics regarding what happened, why did they go up, why did Meta go down. So for those of you who haven't seen the Meta video, go check that one out. For those of you who are not aware, I'm adding to Meta. I'm buying almost every single day. And Amazon is actually a small part of my portfolio. It's actually already in there. It's been there for a couple years now. So I'll be discussing what is kind of transpiring with it now. As far as portfolio moves, I'll discuss what I've done in the past, but I'm not really doing anything right now, so I won't bear the lead with that. So before we begin, actually, let's take a look at the price action. So if we take a look at the 1-year price action, I want to highlight what happened right after earnings. It jumped up about 16%. And a lot of people were confused because the cash flows were quite negative. And, we won't bear the lead. We'll go right into it. So right over here, the first sheet I want to show you guys is a negative cash flow, about $9 billion. A lot of people saw us and were like, ooh, 9 billion negative cash flows. No, thank you. We want to only cash flow positive companies. Well, yes, that is a good rule to have. We have to understand the nuance behind this negative cash flows. So if we actually explore further, they had actually a greater amount of negative cash flows when we also count for less principal repayments of finance leases. So they're basically paying down those principal payments. And then if we also take a look over here at the equipment finance leases, it's about negative $14 billion. But taking a look at the shares, I want to actually comment on how great I like Amazon's slides here. They're straight and to the point. They're not really salesy. They're just, here's the numbers. We're not trying to sell you the business. We don't care if you buy our stock or not, pretty much. That's the kind of the feel I get of Amazon. They don't need to sell themselves. All right, taking a look at net sales. Net sales did grow. What we wanted to pay attention to here was yes, they pulled forward a lot of demand, but not only that, they continue to grow. So not only did a lot of people switch over to buying online, then they grabbed that, and then they actually bought more online this year. Okay. So, and then Amazon, you'll see the cyclicality. So remember, they have Prime Day, they have, the holiday season. So they have a different amounts of revenue depending on what quarter we're talking about. Going over here, I'm going to highlight the most important part of Amazon's business, in my opinion, is Amazon Web Services. This is their part of the business that is the most profitable. It has the highest margins. The remaining parts of the business are all ancillary positions. They're supportive positions. They form a supportive wing of the business, and AWS allows them to make these necessary investments and try to dominate elsewhere. So when you compare Walmart to Amazon, you're actually doing Amazon a disservice. It's not actually making a fair comparison because Walmart does not have the AWS unit. So they don't have Walmart Web Services. They are just a retailer. And in fact, I think Walmart utilizes either Azure or Google Cloud. It's a competitor of Amazon Web Services in order to try to host their online retail platform. And then again, Amazon Web Services is like the crown jewel of this business. All right, going forward, let's take a look at operating income. Operating income is actually a little bit down. Taking a look at net income, operating income trailing 12 months is actually up a little bit. So that's mainly has to do with the individual quarters, right? But they had it trailing 12 months. It adds the full year. So then during the full year, Q4 2021, it was 24 billion. Okay, so they had a good year. Net income is actually up. And then again, we look at the trailing 12 months net income. Trailing 12 months net income is actually up substantially. In this case, I think is a more fair representation of the business. We'll get to it in the cash flows in the next document. But the GAAP net income, GAAP is designed to actually showcase the underlying fundamentals of a business, so management can communicate with us, the shareholders, what's going on in the business. Well, GAAP net income, I think in this case is a fair case or a fair example of that. Remember, on this channel, I usually dismiss GAAP net income in favor of cash flows, but everything is nuanced, depends on the business, the type, the time of year, the time of the cycle they're in, whatever. A lot of things depend on whether or not I'm caring more about cash flows or GAAP net income, and then et cetera. All right, taking a look over here, I think this is fine. We'll actually move on to the next part, and I'll highlight this. So over here, we see the statement of cash flows or consolidated statement of cash flows from Amazon. And I'll highlight this right here, purchase of property, plant, and equipment. This is what's causing the negative numbers or drastic negative numbers. So in your analysis, if you're looking at it like that, you're going to get a negative cash flow, and then it's going to look disgusting. However, you cannot punish the business for expansion. Expansionary CapEx is very important. You have to understand that a lot of that, they're going to receive a very good return on that. So we want to think of it as the maintenance CapEx, right? Because that's what Buffett says. Owner's earnings is cash from operations minus maintenance CapEx. Taking that philosophy and applying it here, we have to then think about how much of that capital expenditure is maintenance CapEx and how much is expansionary CapEx. And I can kind of make a rough estimation as to what that expansionary CapEx might be or close to be. And this is not the most precise way of doing it. This is just kind of like a smell test of sorts. But you can take the depreciation of this year, because depreciation is a form of expense on the property, plant, and equipment. Because remember, when we depreciate something, while it's not a cash expense, it does represent an actual expense, because the wear and tear of these equipment is something that we'll have to replace in the future. Okay, so we do actually have to think about it as an expense. And then CapEx, maintenance CapEx, is us kind of replacing that over time. So the number can kind of be sort of close to that. It's not actually technically the most accurate way of doing it at all, but it's kind of like a litmus test here. I'd say that one really good way of doing it is actually taking a look at the net income here. In this instance, I think that GAAP net income would be a fair reflection of the underlying business. They did a lot of expensing in the past. And in fact, maybe net income is not actually reflecting the true fundamentals of the business either. Okay. But it's a good baseline, I believe, where we can begin. So the model, I'll have it already adjusted. It's already going to be adjusted for that, because it'll understand that there's a lot of growth CapEx going into this business. And if we did that, we would unfairly punish Amazon for investing into its future. Another thing I want to note is that Amazon, that I almost didn't mention, Amazon is actually increasing the subscription rate of their Prime business. For example, I will continue to be a Prime member. They're very sticky. They make my life a lot easier. When I need something, I go on my app and I buy it on Amazon very quick. It's at my door in 2 days, a little bit more depending on if it's a third-party seller. There's so many different ways for Amazon to monetize into the future. They're investing a lot in the smart home category. I don't know how many Alexas I have. There's a lot of these little smart lights all around the house that, you just speak to Alexa and turns it on and stuff like that. So really cool little gadgets that Amazon is actually getting more and more involved in our lives. There's obviously competition, but Amazon is playing all these roles. Okay, going over to the model, let's actually take a look at what we can come up with. And again, it's already been adjusted by the time. And then for the analysts, they have it as a strong buy, price target of 33.8% upside at 4,101.90 cents. And I think it's fair enough that we go to the key ratios and kind of take a look at what's going on in this business. So current ratio, very healthy. I like to see that. Total debt ratio, it's coming down actually. So they're getting better and better and better. Just so everyone understands, 2021 and 2020 are going to be the same, because we just ended 2021 and the model hasn't switched this last year over to 2022. Okay, because we just ended it. So when you see 2021 and 2020, they're both 2021, and then 2019 is now 2020. So it's actually subtract a year and then just understand that 2020 and 2021 is the same. That was a question that was brought up in the PayPal video, and it's just because they just ended the quarter. So we just ended 2021, and then 2022 is just now starting. So that's not going to understand what's going on. And so that's a little bit of a note there. All right. So current ratio, cash ratio, we just discussed that. Cash ratio is improving, by the way. They are actually getting more and more cash in that balance sheet. I almost skipped over that, by the way. That's why I'm going back. Long-term debt ratio, really good. It's coming down from 2017, but it's coming up from 2018. Long-term debt to capital, that's fine. It's coming down over the longer term. Debt to equity, it's great. Yeah, it's good. Gross profit margins. Okay, so this has been rising. I think this is good because more and more of their business is AWS, third-party sellers, fulfillment by Amazon, all of this. They actually expanded their infrastructure to focus on delivery themselves. That, of course, expands margins. Operating margins have actually declined, though, and then net margins have actually risen. Okay, so operating margins are actually declining more likely because they're actually expensing a lot of things, or they're investing a lot into the business to grow operations over time and buying that infrastructure. And then we can see that that's basically a 2021 phenomena, because remember, 2020 and 2021 are the same year. This is actually 2020 over here at 17%. So it's actually declined. So interesting to note. ROA, ROE, very good. I'd look at ROE here the most over ROA. They're going to be a very asset intensive business, especially as they expand all this infrastructure. So I'd look at ROE especially, right? And ROIC, which we'll explore when we get back to the summary page. Of course, I expect nothing less from Amazon. Earnings quality is consistently good. Book value per share is growing and rising. It's not something I really care about. If you get this at book value per share, congratulations. That's extraordinarily cheap. But if I were to get it at that price in the future, maybe something is terribly wrong with this business. I'll just say that. And then let's take a look at this. Of course, something as dominant as Amazon is going to have a negative cash conversion cycle. I expect nothing less. And all these numbers are pretty good. You guys can pause the video here. And again, I have this column here and you can take a look at each ratio. But, for the sake of time, don't want to waste more of your time. Let's go to the summary report. So summary report, the model is actually not surprisingly saying that there's probably not going to be any bankruptcy. Altman Z-score of 6, and the model itself is saying no. So we're good on that. Taking a look at the ROIC that I was mentioning before, it's 17.25%. That's fantastic. One way to think about that is, can you beat that rate of return? If not, then you want the business to consistently reinvest it back into the business, because that's the return that they're getting on the invested capital. Okay, so let's actually go ahead and start performing some discount rates. So 10% required rate of return, applying market average. Let's take a look at the, remember, we're going off of cash flows, and the cash flows have been adjusted, kind of removing a lot of that estimations of what we think the growth CapEx is versus what we think the maintenance CapEx is. So let's take a look and see. I think we can grow it in the midpoint. Let's do 20%, because it is, again, that is revenues growth. Cash flows can grow faster than revenues, especially as efficiencies are realized, et cetera, and stuff like that. Okay, so revenues are growing, and then cash flows can grow later at a much faster rate. So let's actually explore and see what would happen if, for example, they grew not 40, let's do 30%. So 30% growth in cash flows. And remember, you think Amazon's cash flows are a lot. They're actually not that crazy. They're like 30-ish, 30 odd some billion dollars, by the way, is my estimation, which is a lot. And it is going to, 30% would be a tremendous amount, but I'm thinking of, that's like on my high expectation. I think my mid expectation is that they grow in line with revenues. Their cash flows, or their net income, for example, has been growing at a faster clip than the revenue for quite some time now. Again, because now the way we're recognizing it, and the efficiencies that are being realized, and all that culminating into one massive benefit to the company. Okay, so that's what I want you guys to understand. It's not that they're going to grow, that the revenue is going to grow at 30% or 40% or 50%. It's that the cash flows are going to grow at that rate. Okay. So remember, we're only discounting it at 10%. As soon as we increase that, it's going to come down. But let's see, I think let's do a 25%, and then let's do a 10%. Let's do 15. And then I think 10% is fair. Okay, so funnily enough, well, it's actually higher than that in my portfolio allocation. It's about 2%. So I'll talk a little bit about that. Well, it's between 1% and 2%. I'll explain a little bit more in the video dedicated to the portfolio reveal. So essentially, I used to own more Amazon, and I've been selling my Amazon stake. Just because for me, as you can see here in this analysis, when we start to increase the required rate of return at current prices, it's not very favorable to me, in my personal opinion, unless you start expecting some really crazy growth rates in the cash flows, which very much could happen, but it's not something I'm very confident in predicting that level of growth. Okay. So, and I didn't even assume the dilution yet, and that's about 0.91 and then percent. So, I doubled percentage it. All right. So right there, we're basically at the number of 32% assumption in growth rates. So can they do that? Maybe they can, but I'm personally not comfortable assuming that. So I've been lowering my exposure to Amazon in the past year. And, I made really good returns. I'm very happy with that. And I'm redeploying capital elsewhere. I was accumulating cash. And for those of you who've been watching for a while now, in November, December, I was accumulating cash. And now I'm looking at places to redeploy. I'm getting actually more and more excited as we see certain people start to capitulate, start to get more fearful. I'm hoping that we can keep going with the fear, and for example, Meta, and I keep accumulating Meta there. So I'm really excited for my portfolio going forward as I'm redeploying capital opportunistically. I'm going to do a video rather soon, as to how to enter a position, how to exit a position, because those are very crucial skills that I think all of us need to develop. I'm always going to be constantly developing it. You never really become a master. You're always going to be human and make mistakes. There's always ways you can improve, but just kind of like the basics as for what I know now, and then what I hopefully will over time develop even more into the future as I continue to work on this, work in this industry, learn from people who have more experience than I, and kind of share that with you guys. All right, guys, on that note, if you guys like content like this, go ahead and feel free to leave a like, comment down below if you have any questions about anything we discussed here today. If you guys have any other requests you'd like me to look into, go ahead and leave them down below. Remember that there is an extensive list. I'm trying to do it, at least one a day. I try to do 2 a day as the time permits. And if you guys want to see more content like this and you're not yet subscribed, go ahead and subscribe, and we can share more insightful videos together, and talk about different stocks here. All right, guys, I hope you guys enjoyed this video, and I'll see you guys in the next one. Bye.